Everybody, it's been a month. It's been a little while since I made an actual update video on my portfolio, and I am 8.21% down, which is pretty good. The whole market is 28% down. I bought on an average of 20% lower on most companies from their all-time highs, so I I don't feel too bad about that, or the companies that I was buying during this time were quite a lot lower than their all time high. So and just because I have 30, about right, $37,000 in right now. I mean, $3,000 less, so it is 33,000, 34,000. I have quite a lot of money on the side waiting to be introduced into the account. I just haven't done that yet, mostly out of laziness or negligence. I was not in Canada for a little while. I was actually in a different country, so I did not have time to post. I had the worst internet of my life. I was on vacation, and I was having a damn good time. So, sue me if you think that having a vacation is a bad time. Anyways, on to the update, because yeah, I am almost 2.3% down. Very, very good market, very good. And right now we're going through a bit of quite extensive downtime. And there are a few things that I think will play out during this time, and I'm going to explain those to you and why. So obviously, the price to earnings ratio in the market is quite high. It's above its average of 15. For a growing company, I was always told about a 20 to 22 average is considered good. I kind of up that to like 24, 25, just because, I'm a little less. I just don't know how big of a difference that will make, or if it will at all. I guess, 2 PE on top of 20 is 10%, so that's like a 10% raise. I don't really know how that's going to work, but I looked for companies below a 22 PE, which I got sometimes and I didn't other times. So if we go to total value, I still have my $2,000 USD in Apple. I'm still holding on to that. I have an average of 44, and that's gravy to me. I'm going to keep on to that company forever, so as long as it takes, and I will continue to average down because Apple does such a good job at rewarding their shareholders. And yeah. Side note, kind of a side story here. I was on the plane and I was talking to some kind gentleman. We're actually going to take a look. I'm going to make a short about an ETF that he has mentioned to me, and just my thoughts on it. But essentially, he was talking, him and myself. He's been an investor for quite a long time, quite a bit longer than me, and he started off with somebody managing his funds, and then he was a real estate investor who was getting into stocks for the past, he said, probably about 10 years, and he's slowly and surely eased his way into managing the funds himself instead of having somebody managing his funds. Anyways, his name escapes me. He did not sound like he was from Canada. I met him on my plane in Japan. So I met an English person in Japan on my way to where I was going. So, anyways, he and I were talking about how companies reward shareholders in the shape of dividends or share buybacks, because the stock price, it does not always reflect what the company has, but the stock price should be the reward that you get for holding their debt, essentially, or owning their company and the risk involved, and you should be rewarded via share price. So anyways, me and him were talking about that and how companies reward, and how you should be looking for companies that reward shareholders, not just good companies. Which is why I feel even better about buying Apple, even though, albeit I bought it at about a 22 PE, which I think is high for such a big company. So, with respects to that, Apple, it might see a big dip. I have quite a lot more than this in Apple because of other investments that I do own. So, and we're gonna get there. Algonquin Power, a dividend stock, a power stock that I've been buying into this past year. I haven't added to it in quite some time, and I would if there was a big change in price, but not yet. So I continue to hold my 47 shares, and I will be hopefully increasing that in the near future. Alibaba is taking a bit of a dump again. I told myself I wouldn't buy any more unless it was under $75, and I hold true to that. One of my biggest holdings, Berkshire Hathaway, I just picked up 10 shares today. Actually, that order was just filled at $275. I had that order for quite some time. It might show up in earlier videos, but yeah, I've been holding on to Berkshire Hathaway, which is why I have more in Apple than I care to admit, because 44% of the Berkshire Hathaway shares are in Apple stock. Berkshire Hathaway is a holding company of a lot of other companies, which is why I'm treating it like an exchange-traded fund or an ETF. And again, Berkshire Hathaway does a good job at rewarding shareholders. Berkshire Hathaway also has a good past performance of outperforming the S&P 500 during bad down times. So during times of high interest rates and times where, things aren't looking too good, Berkshire Hathaway has proven itself to be a good performer during those times. Now, past performances don't always mean future, but we don't really have you can't decide what's going to happen in the future based on nothing. you know what I mean? Like, how do you know what's going to happen? You just can't tell the future, but you can look at past performance and make a good estimate, which is what I've done here. And yeah, Berkshire Hathaway, a fantastic addition. And the other, because there's 10% in Berkshire Hathaway that I have 12%, mixed with my XEQT, which is another 30%, so 42% of my overall portfolio is now in ETFs. So we're getting closer to that 50% mark. I have a feeling that it would have been at that 50% mark, but even XEQT has been dipping. So, that is just the way she goes. Caterpillar, I have an added to. Dream Industrial, I keep getting dividends from. Same with Nexus REIT. I'm getting about $5 each from those per month, which is just very nice, very cool. Almost enough to buy a share every 2 months. So that's going good. Dollarama is up 42%. Is one of the only stocks that I have that is up. As a matter of fact, as of today, it might be the only stock I own that is up. So, which is super unfortunate. I started buying into that when I was, I bought into that quite a while ago. It's one of the first things I ever did buy. So, yeah, May 2021. So it's one of the first things I bought, and we will hold on to it. Empire REITs, again, another REIT that I really do love. They own grocery store land, or rather land under the grocery stores in quite a few areas, which is kind of what I wanted during a recession, which is why if there's a significant movement, more significant than what has happened, then I would love to buy a bit more, because I think that it is, albeit too small of my portfolio right now. And it is. It's only $200. Google. Holy, Google's been going down. I would love to buy Google sub 100. Actually, I'd like to buy Google if again, significant price movement. If Google hit $90, you bet your left nut that I will be buying quite a bit more. Yeah, just an overall great company that has been rewarding shareholders via buybacks, not dividends, and I would love to be a bigger part of that. Google, very good. Home Depot has been going down. Yes, I believe that I would like to buy more, but without the funds there yet, I will not be participating in that. Intel Corp down 33%. Very, very jazzy. We bought, I bought, I still get dividends from this company. It's still a long-term hold, but it's looking longer every day. So, I won't count this as a loss. You got to give them their due, and I said 5 years, and if they can't show me something in that 5 years, then I will be taking the big L on this one. It's just the way it goes. You're not going to win every battle, but I'd rather hold Intel with $1,000 to zero and see where it goes than sell right now at a loss. I think that would be just a poor idea. Meta, man, I'd like to buy a bit more Meta too. Mine is 30%. I have 8 shares, quite a bit of my 4.7% of my portfolio. So I own quite a bit of Meta, and at a 12 PE, I bought it, albeit probably about a 15 or 16 PE. I don't feel bad about owning Meta. So, yeah, that's just, the name of the game there. I bought a company on its way down, and I expect it to go down further, and it is down further. So, it's not exactly, I'm not surprised at what I've done. And you'll kind of hear that in my tone. I'm not surprised at where my portfolio is because I'm the one who put it here. So all these companies that are down further than, if further than I expect, doesn't mean far enough that I'm surprised. So even though it's not what I expected, I'm not exactly surprised. Manulife Financial, I get one of the other companies that, if I could do it again, I would have put more money in when it was there and accessible as it was down. As a matter of fact, I think that I am down on this position still, which means I am waiting for, I have a market buy. I'm still waiting for another significant move down, 10%, 12%, and I will be buying a bit more Manulife Financial for me. Microsoft, 1 share. I'd love to own more Microsoft. Unfortunately, not at these valuations. They are still expensive. 26 PE. So, I bought my tracker share, which I'm down on. Boohoo. But I am in, and I am waiting for, again, significant moves. Newtek is just a company who, as they pay me dividends, I've just been reinvesting back into themselves. It is not a bad company. They are a rather big company, but they are not rewarding shareholders. They're actually diluting quite extensively, and therefore, as they dilute and as I get their dividends that I'm pretty sure they're diluting to pay, I will be just putting that back into them and not adding any more of my own current funds to that situation. So unless, again, I see a very significant move, if they go back down to like $10, I probably will buy a bit more, because Newtek is an older business. It is, a business that just bought a bank, so they are looking to reinvest in themselves and make acquisitions. I would like to be a part of that, but not yet while they're diluting me. Keep my head on. I got them under a close eye. They also pay far too much in dividends, which is a blessing and a curse. Nexus REITs. Nexus REITs is, again, a company that has been taking a big dip. I am probably going to wait on this one until they reach closer to their mean, which is about $8, because, they've hovered around $8 for quite a long time. Then they dip below, then they go back. So I would rather, and this is just the 5-year, but if you hit the max chart on Vivo, you can see that they've tried to keep their stock price very consistent all the way across. They've also made acquisitions lately, and they're paying out of their pocket. They're diluting people quite extensively. Again, during times when they want to make acquisitions, that is okay as long as I think the acquisition was good. And in this case, they bought more property, so I can only see that as a good thing. I don't think they're increasing their dividend at all, but we will keep a close eye on them as well. Again, waiting for any significant movements in stock price and why it moved significantly. SRU is probably the only company that I'm trying to get out of. Um, I'm not a huge fan of owning malls and supercenter areas, but they do own the land under Walmart. So I think that instead of buying SRU, I am buying Walmart, which was, actually the thought process there. Why own the land that Walmart's on if I could own the company that is paying for the land? Because if that company gets land at a cheaper price, they can put up more Walmarts. Anyways, Walmart's doing okay. It's actually one of the ones that's up because I bought it during a time that it wasn't doing very well. Target and Walmart released earnings, and the earnings were poor. And they were some of the first companies to release poor earnings during this time, which means that they fell by a significant margin. VIG, another ETF that I'm gonna buy, hold, maybe add more to in the later future. I'm down 8% on it again. It would take a significant move, probably 15% for me to add to that position, given that when that position's down, I don't also see something that I'd like to buy instead. XEQT, very much in the same boat. As that is coming down, I will always be buying XEQT. Why? Because it should represent, at least 40% of my portfolio. Right now, it almost does, not quite enough as much as I'd like, and therefore we will continue to buy XEQT as it comes down. It is my broadest base index and one that I have a lot of, a lot of hope for. The reason why I picked this instead of the S&P, again, the S&P, I don't perceive America to outperform, Canada and the rest of the world. I believe America has been dominant for so long that I would rather have my money split up around the world rather than in America, where I think things are just priced too high. So again, this is just a good way to diversify what I own into many different countries. Obviously, it is a heavy part US and Canada, which, I still would like because they have, historically been the places to grow your money. However, it also comes with a bit more risk in emerging markets, which is something that as a very young man, I am all about. Anyways, guys, I'll see you next time. Bye.